Good afternoon, everyone. Let me extend a warm welcome to all my esteemed panelists. Today's topic is very relevant, specifically for NBFC sector and on an overall for the BFSI industry. To our good luck, we have a list of panelists who have been at the forefront of innovations and transformation in BFSI segment. We have panelists from neobank, P2P lending, NBFC, digital gold lending, microfinance, payment transaction processing, and traditional NBFC, which is moving towards digital and transformation. So the future of BFSI industry is kind of going to see a lot of changes, and some of them have already been in progress. Like the partnership model is evolving, and quite a few of our panelists have been engaged in that. Ecosystem models are evolving, where non-traditional players are also integrating with the BFSI players to provide products and services to the customer, from product centricity to customer centricity, convergence of platform. Now, that is something which is emerging. Now, all of these are getting enabled by heavy investments on technology. Now, one side we have fintechs, the other side we have big techs, and in the center we have the BFSI player and customer sitting on top of it. That's the future which I kind of visualize. So, without doing further delay, let us start the discussion. And let me first start with Mr. Kunal. And Kunal, I have a very pertinent question to you. We have been hearing and seeing a lot in the big tech and fintech space on partnerships and collaborations with traditional BFSI players. What are the viable models evolving?
Sure. Thanks, Asim, for the question. Uh, you're right, a lot of collaboration and partnership coming up these days, and different models evolving depending on the interest levels from both sides. Let's say the traditional, BFSI players versus the new models being proposed by the fintech space or the big tech players. Probably we can highlight a few very obvious and most popular partnership or collaboration models. One is a model wherein it's a very tech heavy service oriented partnership model, which is typically called a white labeling, wherein a new age player, which is more strong on the tech DNA, they come in and they offer their technology service to an existing BFSI player. So they become the backend for creating a complete technology front end design layer, and the brand is of the traditional BFSI player. So they provide a technical service, and they become a service provider in that sense, and they manage the white label solution for the BFSI player. So that's number one. Second is a lead generation kind of a model, which is a primarily like a business heavy interaction, but again a very minimal integration or interaction, wherein a new player such as a fintech player or let's say any big tech comes in and they have a large number of customers or access to a large customer pool, and they offer that to existing BFSI players, which may be in the need of expanding their network, expanding their segments, expanding their distribution. Now, traditionally, BFSI players do have an entrenched customer base, but when it comes to expanding to new segments, kind of trying to look at new kinds of products, experimentation, etc., they do rely a lot on this kind of a partnership model where they get a customer lead or a distribution from some of these players, and then they take the customer, and from there on, they put the customer through their business process, product, everything, and in exchange, they give a certain fee to the fintech player for providing that customer lead. That's the second. The third is a capital only kind of a model, wherein a BFSI player, an incumbent, has access to large pools of capital by being an established bank or an established NBFC. But they don't have strengths in other areas, particularly technology or product innovation or large scale distribution or new segment access on they are and they are on. And this is where they collaborate with a fintech player, where they provide their capital. It could be through different formats, such as co-lending or wholesale lending or some other arrangement. But they provide their capital, and the other player uses the capital to then power transactions or disbursements or something else to customers. So essentially, the traditional player is providing a capital, and they get a return on their capital. And it could depend on the nature of relationship, where they could, in addition to the capital, also get something else, like they could have access to the customer base so that they can do future cross sell and upsell. So this is the third model where there's capital. And the fourth model, which is probably the most complex to implement, but the one where the incentives are the most aligned for long term success, is a full stack integration. Now, this is something wherein if you think about any financial product, right? For example, a credit card or a savings product, or let's say a wealth management product or a lending product, end to end, which is full stack, right? From identifying a customer, onboarding a customer, operationally processing that customer, then managing the product transaction lifecycle, managing reconciliation, payments, and so on, and then retaining that customer over a longer period of time to do multiple interactions and engagements. That is what we call full stack. This kind of integration means that both the fintech player and the BFSI player would have to get into a deep technology integration such that their servers and systems can talk to each other on a real time basis. Data is exchanged through secure channels on a real time basis. And the customer journey is then managed on a sharing basis based on whatever alignment they have. And from a business standpoint, this translates into revenue sharing, cost sharing kind of arrangements. This is the most deeply entrenched model. And it is not easy for everybody to execute on this model because it takes a lot of things to come together, not just technology, not just business alignment, but actually meeting of minds. Wavelengths have to match. People should like working with each other. So all of this put together ultimately becomes a full stack integration model wherein they have maximum success aligned. So those are the models. If I were to just summarize, it could be a white label, it could be a lead generation, it could be a capital only, or it could be a full stack integration. Asim.
Well, thanks, Kunal. And it's very well summarized. And two takeaways I can take from here. One, a particular customer segment, a new product, and which is a win-win situation for both the partners to expand the reach. So let me extend it further and let me come to Mr. Salimath. And you have been servicing a particular segment of customers in the microfinance space, and it is technology enabled. And you are dependent on partnership to expand the reach and also provide credit to the unbanked population. What are the challenges being faced in building partnerships and collaborations, and both on the big tech side of it and fintechs for traditional players like you who have been in this industry for quite some time?
Am I audible now?
Yes, please.
As far as involvement of technology in microfinance sector is, right now, these are all people who have their income not credited into their account, still largely dependent on cash economy as far as small towns and villages are concerned. In case of metropolitan cities, slowly, they are receiving cash into their bank account. So when they start receiving the cash into their bank account, then it becomes easier either to track their flow of income and to facilitate the repayment of the loans. The technological growth in microfinance sector has happened in two counts. One is integration with the credit bureau, wherein the customer history is now being taken. Through the service provider, it is possible to check their credit history and take faster decision as far as selection of the customer is concerned. And disbursement is happening through various UPI interfaces, and almost 100% disbursement is going to their bank account. To that extent, the advancement of microfinance using technology has been taking place. The next part is how do we collect the repayments? Though various platforms are being used like PhonePe, Google Pay, and all that, they have been enabled, but the customers are not at in a state where they will be able to automatically arrange repayment through these systems. So until that time, this high-tech integration in microfinance is a challenge. But slowly it will evolve, and the players like PhonePe, Google Pay also need to penetrate into the rural sector. So once they do it, and when the usage of smartphone in the rural sector increases, which is increasing very fast, we could not have imagined, but so fast it has been integrating. Until that time, full fintech integration in microfinance is still a challenge.
Well, thank you for that insight because in multiple discussion, multiple forums, we talk about fintechs, big techs, investing and building this part of it. But from the ground reality, is still the viewpoint is that it requires some more investment, some more products which are very suited to the rural economy and which can help
Definitely.
to further extend the credit disbursement in this particular economy.
But it
So
is
that's a good.
encouraging.
Yeah,
We can move fast.
sure. So thanks. Let me just move to Abhishek. So Abhishek, as now we saw two viewpoint. One Kunal where he explained the models, and Mr. Salimath kind of gave a balanced view that it is encouraging, but yeah, there is still a lot of scope to be worked upon. Now, based on your experience in the industry, and you have been at the forefront of payment transaction facilitation, making it easy, seamless. Now, whether it is disbursement or whether it is collections or kind of interconnecting everybody. So you are almost sitting at the bridge on both sides of it.
Yeah.
So what should be the enablers to make these partnerships successful? What should be the future in this side of it?
Thanks, Asim. And I was really hoping that you'll ask me this question because that is the core competence that we bring to the table in the discussion today. And thanks for sharing the viewpoints that have been done by Mr. Kunal and Mr. Vivek. And yeah, I completely agree with Mr. Vivek that cash continues to be a challenge in the economy. And that is where cash free comes into the picture. So we are trying to free the economy of cash. And uh, so there could be multiple enablers that we can always debate upon. But I'll be a little greedy here. My number one enabler would be the user journeys. So till the time the user journeys are simplified, the onboarding of the customer is very, very quick, the disbursements are seamless, the repayments can be automated, the reconciliation for the NBFCs or the BFSI players is automated. I think that's a good starting point that we have. Uh, as cash-free payments, you'll be surprised that we've processed about 1.5 lakh crore rupees of transactions in last financial year, and we are hopeful that this will definitely grow by 1.5 times this year. And a major chunk of this comes to us from financial services. So that's a very heartening fact. And with the new introductions of UPI 123, which is for the feature phones, I think Mr. Vivek's problem should also get subsequently overcome. And yeah, so like I said, the enablers are there. We are at the forefront of the industry when it comes to handling payments. And proud to say that we've onboarded the seven largest insurers of the country, and we have the top 10 NBFCs who use us for various services. We've built a complete stack in terms of getting the customer onboarded. We have a banking as a service channel wherein we can enable KYC for NBFCs. Uh, we can enable bank account validations. That is the biggest challenge that the NBFC industry faces today. So there is no chance of going a disbursement going wrong in the ecosystem, which we are trying to mitigate. And yeah, so I think the opening remarks by you, Asim, where there's a pyramid and the customer has to sit on the top of the pyramid, is the key takeaway for me from this discussion. Yeah. Thanks. Over to you, Asim.
Thanks, Abhishek, and thanks for sharing that. Now, let me move to a bit of sensitive topic. And Sumit, let me put you on the spot. So, in developed economies, we have seen regulators are quite proactive, and they have been taking a lot of initiatives and trying to see that how technology and different models can be leveraged. And some places they have given the leeways also to expand. And we have seen it in the US market, UK market, Singapore market, where the regulators have been kind of collaborating among themselves. So that's what we are seeing these days, where it's not only the fintechs or the big techs collaborating, but it's the regulators also collaborating. Now let's take the Indian market. So are there any support required from regulators, or which can further increase the speed of innovation or remove the impediments or the roadblocks that are existing today? Because one of the challenge which I see that valuations has been increased, but the scale, which can compete against the bigger players, etc., still it is not desirable. So what do you, Sumit?
So thanks, Asim, for the, and thanks everyone for the invite. So if I've got the question correctly, the collaboration between the regulator and the private sector, how it can lead to more scale, because we're just getting started from a fintech perspective. Is that correct?
Yeah, that's true. Because how regulator can enable it, how they can be more proactive and be a step ahead. Yes, sandbox, all those things have been going on.
See, I think, yeah, I think, we are bit erratic as a country in the near term, but very rational in the long run. If you look at, without taking and blaming it on either regulator or policymaker, even our corporate side, or just the way our institutions are built, if you think about it, UPI took some time, but now look at the compounding. It's just growing disproportionately higher. You have the very nature of this country that somehow our institutions are built in this way. Now, from that perspective, if you look at it, currently the new structural reforms which RBI has been building, whether the simple initiative, just building a different CGM and a different, vertical within the regulatory realm, which will deal with these digital initiatives, and a single desk which will look and build a holistic policy, might seem like a small initiative, but it is going to compound over a period of time. It's just getting started. It's just getting warmed up. One of the one of the challenges which is there is the open to interpretation laws on the circular and the ambiguity which it creates. There's a lot of unnecessary friction which can be curtailed if there was a more clarity on how these circulars have to be read. Because if you look at the challenge is not with the regulator, but the interpretation drawn by the risk policy compliance different parts of the different banking and non-banking institutions. And ultimately, it is the bank's ability to generate low cost of capital and NBFC's ability to innovate on the distribution and risk appraisal side is the unlocking of the credit in the country. Now, for this to happen, we are leaving a lot of room for open for interpretation by every bank's risk policy compliance, and every RBI inspector is going to do audit. I mean, these are practical challenges which I'm sure every institution in this call and outside has faced. There is intent to abide the law, but the clarity, a lot of times there is confusion and not crystal clarity on what is kosher and what is non-kosher. So I think that is one place where there's a lot of room for improvement. Second, on the flip side, but if you look at how regulators have thought ahead of time, and certain things which are quite interesting is how they have put out co-lending guidelines. I mean, I think that's a great initiative for a long run, where if you look at now Chinese regulator, you look at US regulator, European regulator, everyone is realizing, what, the lending is somewhere where you have to put skin in the game. And financial has been trying to change that, from a 2% risk participation to now 30%. And RBI was ahead of curve in 2008 to put 18 to put the CLM1 model, co-lending model 1. But again, the circular even today has so much room open for interpretation that it's not coming into enforcement. Now the challenge is, we as young companies are going through the valley of death, because there will be a lot of confusion, chaos, and the next couple of years are going to be a bit irrational, which all of us have to figure out how to navigate. But structurally, once we are out of this, and then we reach closer to steady state, I think it's a beautiful initiative. It's going to compound, and what we saw in UPI, there will be a credit unlock for the nation. So as I said, erratic in the near term, no one's to be blamed. It's just how institutions are built in this country. And structurally, I am very optimistic, and rationality will prevail, and there will be goodness in the sector.
Thanks, Sumit. Erratic in short term, rational in long term. Innovation on distribution and risk appraisal, and whereas the banks have to bring the low cost of capital. But somehow the co-lending model with such a fan following and everything was put up on the table, but it has not taken off because somewhere the challenges have been there, issues have been there. The banks don't see a
So
systems were not work.
I'm taking this call from a bank's premises only, and I
Okay.
can tell
So
you, I just
sure.
finished a meeting with their head of retail, a large blue chip private sector bank. The point is, it is the co-lending model too, it's changing. The board approved, it's again bureaucratic machinery, even on corporate side. Because the RBI inspector who's going to come and ask, boss, show me the board approved policy. For that, the entire machinery has to come together. So point is, there is a movement, but on a 10-year scale, it's so small, it's not visible, and let's not get disappointed. We have to figure out how next couple of years going to be, which is the turmoil region, and after that you will see, definitely you will see the compounding happening.
Thanks, Sumit. So still you are positive, so which is good. So now let me come to you, Abhinandan. And you have been in this industry, you have worked in banks and financial institutions, and then jumped into innovation, bringing to the financial sector. So what are the areas where collaborations can or have succeeded? Now, some of the things which people talk, and Sumit was also talking, Abhishek was talking, acquisition, customer servicing.
So the collaboration does play a very critical role, but we need to be cognizant of the fact that as fintechs, right, the rapid innovation that happens and rapid go-to-market strategies that we bring in, the customer experience that happens, and the algorithms and AI elements that we keep building regularly, we need to protect our IPs. We need to ensure that that is something that stays core to us. And as one of our other panelists was talking about, white label solutions helps where we retain the IP, but at the same time enable our other partners in the ecosystem and to move faster and to scale quickly. So this will also help in we maintaining that gap from both sides of the spectrum, if you know what I'm trying to say. That is the only way that we can continue to uh, uh, make protect our niche and continue to grow. Right now, we help the traditional financial institutions and banks to reach new goals and to increase customer engagement, providing with seamless digital experiences, of course, the cutting edge tech capabilities that we all are aware of. But one important thing that is emerging that we are trying to unlock too at Finzy is trying to go the platform route, which is more of plug and play services. Today, the tech resources or the access to this is, very scarce. It's very difficult. So how do we avoid that dependency? And that is only possible when we build all these solutions and services in a platform way, which would help our other partners to unlock it by using the plug and play mode. And this is where the ecosystem comes handy. You don't need to build everything. You need to understand what your area of expertise is and which is the area where you want to invest in IP. And the other aspects, you can collaborate and partner with them. And this is going to help banks, obviously, to reduce their costs, customer acquisition cost, help them go to markets much faster, and sharing the trust which they have built for long times. So this is how I'm seeing all these things happening. Now, coming to the other aspect of the question that you are saying, yes, there are great strides of innovations that are happening in collaborations. Customer acquisition per se. Again, what we are doing is with data, with insights, we're able to target customers better. We're able to reach out pockets, younger audience generations using social media or Insta, etc., which was not easily unlocked by the traditional institutions. Now, there is a win-win over here. While we understand these customers better, we need some of the know-how that the banks possess. And together we need to work and we need to ensure that the customer is not owned by only one set of audience in the ecosystem. We need to ensure that it is co-owned. At the same time, obviously, regulator is very cautious about it. You can't have customers' data being used by 7-8 players in the ecosystem, talking about the account aggregator platform and all. So there are checks and balances kept so that the data is not being misused. The distributed ledger technology, the DLT and all are helping in it. But it will help us reach out to these customers and unlock the potential. Now, again, customer servicing is another great area where we can collaborate and coexist. The unified communication, because we don't know where customer is, right? Oh, there is a kahavat, right? Wo janwar kahan pani peene jata hai, and we need to be there at that specific point. And these are the areas where we can help in the way that the customer wants, right? And we have insights into it because there are various other touch points that we look into. So at Finzy, we just don't believe in being a matchmaking platform connecting lenders and borrowers. We believe in believe in being a whole loan lifecycle management company. So right from origination to acquisition to underwriting to documentation to KYC to disbursal to funding them and collections and recoveries, all of these aspects happen in house. But there are areas where we know that this is an area where we don't really need to build, but we need to buy, as in we need to partner and get insights about. One example is some of the companies are doing phenomenal stuff with fraud detection. They are able to understand, there's a lot of cognitive science also that gets involved over here on the app or even on the laptop, how much time a borrower or a user is taking to navigate from one page to another page, right? Is this humanly possible, or is this a bot that is trying to do, right? And is this the same user because he has come or she has come to the platform and application, and we kind of know the amount of time that person takes to navigate from step A to step B to step C. But this is looking very unusual. Can we intervene over here? Or while there is a lot of self-service being talked about, automation being talked about, but somebody needs to stay on top of NPAs, right? Somebody needs to keep a close check on what is going wrong. So these are some of the aspects where we are able to collaborate and where we are able to build strong models, demonstrate with data, and that is helping us forge stronger relationship with financial companies like banks. And underwriting, again, if we were to use the same set of CIC, the credit bureau scores, and deciding, saying that, hey, the score is more than this and let's go ahead and give a loan, I don't think what is the novelty or what is the uniqueness that we are bringing in, right? And this is where we wanted to differ, and we wanted to look at different models, different data sets that are going to be available. And it takes time. And this is where we need partnerships with BigTechs too. They can help provide access to these large set of customers and their data. Again, when we demonstrate and prove it to them, saying that this is going to add value and where we are going to complement them and not really sabotage their lines of e-commerce business or something around it. And that is where the holistic aspect of building a Finzy score, what we call it, very similar to the CIC scores, but that looks at various parameters. It's just not a number that's on your forehead saying that this is my credit score and will I get a loan or not? How many seconds will I get a loan? So that is an area that we are trying to now partner with other companies and help them. What are the aspects that you can look into and how you can use these algorithms and these models and have a better control on who do you give loans to, if it is NTC or if it is existing customer, and at the same time, how do you control your NPS? And one last point, Asim, I would have loved the question that you asked Sumit around the regulatory help that we need. We are a nascent industry, right? The P2P NBFC segment that we are in. RBI has done RBI, I mean, the regulator has done a phenomenal job in limiting the number of players in this space. They've been watching this space closely, and recently, last year, they increased the limits for lenders from 10 lakhs to 50 lakh rupees. But if we want to scale this business up to be something like the next mutual fund industry, we need banks to participate. I'm going to use the word co-lending, but it's not the same sense as what Sumit was mentioning. It is slightly different over here. So in our P2P space, how it works is it's a platform. Investors or lenders come in and they get access to multiple handpicked borrowers, and their money gets deployed to them via Finzy, right? So now an investor investing ₹1 lakh could be investing this in 100 borrowers at a rate of ₹1,000 each, right? But now if we have to scale the business on one side, that is demand, which is on the borrower loan side, we will have to ensure that the supply part is taken care. And we feel this is possible when banks and institutions participate. But with a ₹50 lakh limit for lenders, banks are not going to take this seriously. And this is an area where if regulators can remove that capping for banks and institutions, we can see their participation happening. And this is a classic case of how a collaboration can go a long way, right? Typically, banks spend a lot of money in customer acquisition, working with aggregators and getting the leads, right? And spending a lot of their names, the margins that they share over there. Here, they get access to curated loans, the best of the borrowers, the diversified customers, retail assets, and in a fraction of a few seconds that they get to deploy this. This will help us because when lenders see that, hey, bank is also co-participating with me in investing in these borrowers, the big brand and the trust that just helps scale the business on investor side. And once it scales on the supply side, we will be able to open up all channels on the borrower side because our personal loan rates start at 7.99%, which is unheard for unsecured loan in India.
No, sure, Abhinandan. So I think that's a model which you're kind of suggesting, so which can be taken. But one thing which I can take it from here is the customer servicing side of it. So as a financial industry, services industry, we have always been weaker on that aspect of it. So which is a good area to kind of focus and innovate. But let me move quickly to Durgaprasad. And sir, you have been at the center of this whole journey and transformation as a NBFC, and you have seen this whole movement which is happening. So one side the BigTechs, one side the Fintechs, etc. What has been your experience, your understanding on that? That has it helped you on the innovation side of it, leveraging analytics? Has the BigTechs like the Google, etc., have provided certain capabilities which you can leverage for better business? What's your viewpoint on this?
Thanks, Asim. I think like what Abhinandan and Kunal had been mentioning, right? You have the Fintechs on the digital end of the spectrum, and then you have the traditional organizations who kind of started off on the brick and mortar or the physical end of the spectrum, but are moving towards digital, so to speak. So, and that's where now you see a lot of partnerships, coming up between those at the digital end versus the traditional organizations. And I think Abhinandan also mentioned quite a few areas where we need to go beyond, from a pure analytics perspective, go beyond the pure kind of a bureau scores to what are the alternate data options, right? Because not everybody is having a credit history for us to go ahead and underwrite them for. So you may have alternate pieces coming in terms of even things like socioeconomic profiling, what kind of locality they are coming from, and what kind of affluence that area may have. So those come into play, and I think that's where Fintech with their kind of born digital, born data native kind of approaches really help some of that capability and work in partnership with a traditional organization. And what I see is maybe beyond Fintech, because see, when you talk with a Fintech, that's a point where a customer is intending to do a financial transaction. But I guess if you go beyond that and look at it from an embedded aspect of finance, then you go and like I think I also mentioned, you go beyond the traditional lending to say, what if you are talking about an e-commerce organization or a personal mobility like a Ola, Uber, or a food delivery setups.
Good afternoon,
and that's
everyone.
Where I think we need to.
I think Mr. Vivek's problem should
be the level of maturity,
innovation, bringing acquisition, customer servicing,
really becoming a game changer, because that's the point where you're not starting off with a financial kind of a thing in mind. You want to do a different kind of everyday life transaction, and then financial transaction gets embedded at the point in time, and that's where we feel that there's going to be significant innovation. And historically, investment or money flows in where there is a flow of money. But I think we are at a point in time where money is going to flow in where there's a flow of data. And that's where, as money flows in, you will see significant innovation. And that's where the core partnership of people who come with a strong analytical capability, the engineering side to derive significant insights from data. And then you have somebody who comes in and says, I have the financial know-how, maybe support you from a balance sheet perspective, all come together and really expand the market that this is going to operate in.
No, that's one very interesting point you said, that where the data will flow, money will flow. Now, that is the radical shift from the perspective. Earlier, it used to be the customer, you have to come to the money. Money will not flow to them, but that's radical. Now, let's extend this further. And coming to you, Kunal, will it lead to a convergence and some new kind of player will emerge who kind of has the customer's attention and the need-based financial transactions are happening? It can be payments, it can be credit, it can be liability product, or some kind of embedded finance. What's your view on that? Because we are seeing that most of these financial institutions, the big one who started with wallets and etc., or who started with brokerage, online digital brokerage platform. Now they are trying to, integrate backward to certain other products and services. Or maybe the big techs like the Amazons and the others of the world, they have the data, they own the customer data as of now, because that data is less regulated, and maybe the privacy will come, and with the consent of the customer, if the new products and services can be offered. What's your view on this?
Sure. Asim, that's a fairly loaded question. Some couple of key words thrown there, like big tech. So maybe I can answer it in parts. One of the things about uh, our regulatory landscape is that very strong pro-consumer sentiments as far as the regulator is concerned. So whenever we talk about something new emerging, whether it's a business model or a new company coming and maybe trying to grow horizontally and get into newer services and offerings, one of the things that the regulator definitely seems to be pushing for is not having monopolistic data ownership, ensuring privacy, and not having cross-pollination of customer information without due consent, without making sure that there's no predatory pricing kicking in, no, I would say, vicious debt cycles getting created. So some of these elements are there which the regulator is going to strongly watch out for. And it may not be so straightforward for a big tech to just come in and establish, let's say, a very large horizontal play in that sense. It remains to be seen how it benefits the customer at the end of the day. But coming to the first part of your question, which is, do we think there'll be some kind of convergence, new kind of players emerging? So let me try to answer that question from first principles and the bottom up. Like, what does it really do to a company who starts entering into one segment? And that will probably help us answer the question, are we going to see some convergence? So typically, any company which is coming into, let's say, financial services needs to have a very strong hook as to why customers should come and maybe fall in love with their product or their service, give them their trust, give them the information, and in exchange get some value. So typically customers look for a very specific need, and that's how an interaction starts with a brand or a product. Right, my colleagues over here, like Sumit from Rupeek and Abhishek and Abhinandan, they all talked a lot about how customers engage and how they're looking at it from a business standpoint. One thing I think all of us will agree that it is not enough to just acquire a customer. You do need to have a clear way of keeping the customer with you and engage and retain those customers. Otherwise, your business creates a leaky bucket. When you spend upfront money, you compete with other brands to spend on digital channels, advertising. You see tons of IPL is coming up, and you'll see tons of ads coming up with like Fintechs. Right, there was a time when startups had overtaken the number of ads in the IPL spots as compared to established companies. So people are throwing a lot of money over there, which is to acquire customers. But what we don't see is that a lot of leaky buckets are getting created. So companies will be forced to get into businesses where they have to create deeper, sustained engagement with those same customers. So just opening an online account for a customer to perform a particular task is not sufficient. Will the customer come back to you automatically, or will you again have to spend marketing money to reacquire that same customer? Hence, your incremental costs go up. Hence, your unit economics come under a lot of pressure. These are fundamental questions which will help you answer whether there's going to be like a larger convergence in the space or not. So I think what we see happening, and this is one of the things that we at Freo, which is, we are a consumer neobank, and one of the things that we have been very sharply focused on is, no matter what the fads are out there, which is about throwing a lot of marketing money, which is essentially investors' money, to just get customers to you and then show vanity metrics, and then again simply keep showing vanity metrics. That is not the right way to build a long-term business. If you want to be around as a brand, as a sustained business, you do need to have multiple things. One, you need to have a smart and efficient growth engine. That might come from one line of business, one line of service, one line of product, or let's say multiple. Second, you need to be able to retain those customers and engage them such that they interact with your ecosystem, not by you giving cashbacks alone. Like I'm like, come and transact with me, I'm going to give you cashbacks. The music will stop one day if it's cashbacks, right? So you do need to have a sustained retention and engagement. And third, you need to have a very clear line of sight to monetization. The ultimate purpose of a business from a shareholder's lens is to generate economic value for everybody in a sustained manner, right? So any business who is constantly hungry and dependent on external capital might look very cool and exciting as far as reading startup news is concerned, but that's not how you build a business, right? That's like just kind of you never grow into an adult as far as a business is concerned. You remain a kid and a teenager. It's very cute to talk about it. So if you have to put all of these things together, you as a business will see yourself evolving, and we will see the space, a lot of signs of convergence, as in companies will expand into different verticals where they will have to connect the dots between one vertical to the another vertical, where the customers see a natural linkage. So offering a fintech product and suddenly getting into e-commerce is a very unnatural linkage. That is not an example of conversion. That's an example of like a forced retention or a forced engagement. But customers will go to some other platform for e-commerce and go somewhere else for finance.
Kunal, I will
Like
just
that.
interject. I will just interject here, and I will also invite Sumit to comment on that part of it. So, and Durgaprasad was talking about embedded finance and about
Yeah.
OCEN, right? Open Credit Enablement Network, etc. So, and that's very, very powerful thought process that we are looking at it. So, Sumit, just moving to you on that part of it, do you believe that this will kind of, so you have the agri tech, you have the health tech, you have the pharma tech, all of that, somewhere the finance, the underlying finance layer is required, right? Not only from that, there it is generating a set of data, it is having certain financial needs, and the customer is at the center of it. So, what's your view on it? Like, Kunal kind of explained a lot of things, and he is still skeptical on few of the things on the boundary line of it. But from your perspective, Sumit, what do you think?
Yeah, I think I'm very of time, so I'll keep it very short. And one of a very seasoned, veteran who has seen evolution of Fine Financial very closely, told me that it's a race where uh, the finance guys learn tech first and customer centricity first, or tech guys learns finance first and centricity first. It's a race of two lanes. A regulator is backing the finance guy learning tech first, and not the tech guy learning finance first. Now this is a profound statement, and the manifestation of this is that at the core of it, if your regulator and policymaker believe it's finance, you have to do that marriage, commit to that skin in the game approach, and then it can be powerful. So and I don't truly believe that it's actually one guy cannot learn the other. It's more of a mindset. So when you are dealing with risk compliance, you have to wear the hat of finance guy. When you are dealing with customer centricity, anyone can learn anything. It's just the two swim lanes where people are competing today.
Very profound and very crisp. Thanks for that, Sumit. So, Abhishek, coming to you, any last word on that?
So my last word would be that the financing part has to converge, whether it's an agri-tech, whether it is a health tech, and banks will continue to be dominant in that area. So a couple of panelists have said that unless there is interest from banks into the lending space or the co-lending space, it is not a sustainable model. And end of the day, just wasting investors' money in advertising and again trying to acquire customers is not the way forward. So I, as a consumer, want a one-stop solution where all my needs are getting met. These needs could be investment needs. These needs could be my borrowing needs. These needs could be managing my savings account or current account. So somewhere I definitely see that the convergence needs to happen, and it is bound to happen.
Thanks, Abhishek. And coming to you, Mr. Vivek, in the microfinance sector, one need which you believe that the BigTechs or the Fintechs can help you to solve it and expand the reach of your customer segment, taking finance to them.
Yeah, it's only as far as the repayment is concerned. If you can develop an ecosystem and infrastructure in the rural area where even the small income holders start receiving their income into their accounts. So that will solve most of the problems. Whatever innovation that are possible into the sector using the existing digital method has really helped. And the algorithm on risks, that's another important factor. In microfinance, social risk is another factor which has caused large-scale default. So we need to look at this risk and develop algorithm wherein we can find early warning systems in that.
Thank you. So let me take this opportunity to once again thanks the panelists. It was very insightful. lot of pragmatic suggestions and practical suggestions. Future is looking good for NBFC with different models evolving. So wish you all the best. Thank you.
Thank you.
Thank you.
Thanks.
Bye.